With 2019 coming to a close, it's time to flip the page and enter into the new year. And while most are excited for Christmas shopping and holiday festivities, all I want for Christmas this year is for old St. Nick to give us some good deals on stocks. Luckily for you, me and the gang have been working day and night to find the hottest deals on the market. Here at the office, the elves have been working tirelessly, crunching the numbers, scouring the options of stocks to buy. It's been nothing but hard work on our end. Well, I guess I shouldn't say that. They do get a little sidetracked from time to time. Actually, I guess pretty much all the time. When I'm not around, I'm not really sure what they do, but we're excited to share with you our findings and highlight 3 stocks that I personally plan to buy in 2020. They've been so hardworking and they absolutely love working for Brandon Beavis Investing. I couldn't have asked for a better team. Enjoy the video.
In the building.
What is going on, you guys, and welcome back to another video. My name is Brandon. If you are new here, we post a video every week, so be sure to subscribe and do click that first link down in the description below if you want to learn more about our investing academy. But I figured this is a video that I only get to do once a year, where I'm actually detailing 3 stocks that I plan to buy in 2020. So I figured we'd make this one a little bit special. As always, keep in mind this is not investment advice. Always do your own research, always do your own due diligence, but let's dive right on into the video. Jess, grab me that paperwork for the first stock. Excellent. Thank you. The first stock that I will personally be buying in 2019 is the company New Flyer Industries. The ticker is NFI.TO. It does trade here on the TSX, and it actually does trade over the counter. If we do have any US viewers, it trades under the ticker NFYEF, but we'll of course be referring to the Canadian one for this video. And New Flyer is a company that is actually based and founded out of Winnipeg, Manitoba. They are a leading independent bus manufacturer. So a little bit different there, but NFI Group is technically the parent company. Their business kind of breaks up between New Flyer, which produces these heavy-duty transit buses that you see around your local city. You very well may use one yourself. Alexander Dennis, one of their brands responsible for producing single-decker and double-decker buses. And in 2015, they acquired a company called MCI, which is actually North America's largest manufacturer of motor coaches as well. So they really do have a pretty good reach here across the bus industry, with a leading market position in North America in pretty much all angles we see here, aside from school buses and high floor, which they do kind of lack. The company does service both the public and private market. They as well have a component of their revenue derived from aftermarket parts, which we know is a very high margin business. And you will notice here their bread and butter, making up about 3/4 of their manufacturing breakdown, are the heavy duty transit buses. That's really what New Flyer is quite known for. They actually have over 105,000 buses and coaches that are currently in operation. And this history dates back to about 1930. So they have been a long time. They've been around for a long time. They've been in the bus business, the transportation business for a while. You will notice, as of recently, the inclusion of the electric and eco-friendly buses, which I think is just a great sign of adaptation. You will notice the stock is down about 50% off of its highs. It's actually trading right near its 52-week low. And with the stock dropping down so much, I'm starting to believe this is actually dipping into some fairly attractive buying periods. The stock's currently valued at a forward PE of 12.5, and the starting yield at these levels has creeped up to 6.44%, which is just great. They've actually paid out and increased dividends since the company IPO'd back in 2005, the most recent increase being a 13% raise from the previous year, all doing so with a 50% payout ratio. So a lot of information there to unpack. Why I personally like this stock, and I have touched on this a couple times on the channel if you do want to look back on some previous videos. As of recently, we have been seeing some insider buying, in particular over the past year. That's not saying this is like the be all end all in my decision, but it's usually a good sign when the company executives are happy buying back their shares of their own stock. There's been about $1.6 million in total of buying around the $25 to $27 levels. Negative that we do have to point out here is that New Flyer's debt has been increasing. And this has really been the primary driver of the 50% decline that the stock has had. They've seen this debt number actually climb up to $1.2 billion. And yeah, debt in many cases is a very scary thing for investors. It's something that we don't typically like to see. A lot of investors try to shy away from companies that are carrying these big debt levels. But we do have to keep in mind that it is also a very normal part of business. And at times, companies do carry more debt than ideal. But one of the bright spots here with New Flyer is they actually posted their Q3 earnings. They posted record deliveries. So over 1,300 units, which is up 34%. The company also has a backlog of orders that they are yet and planning to fill, which helps fight off the talks of recession, which is an obvious concern. And basically, as the cash flow increases, and management puts the effort on paying this debt down, which is something that they have made the commitment to do, I'd make the argument that these debt concerns, which are legitimate, they may already be priced into the stock. Hence why we've seen this 50% drop. If we were to see some positive news going forward about deleveraging and decreasing this debt levels, I've actually got my fingers crossed for a nice little turnaround with the company New Flyer, because what's fascinating to me is that the debt is really my only concern here with the company. It's the only dark spot, while the rest of the company is actually performing quite well. So all in all, I do like the uniqueness of this company. I like how they have a very powerful grasp, a very, very dominant position in kind of like a different market. Like, to me, owning a stock in the bus manufacturing space is just kind of different and cool. I actually did add the stock to my portfolio back in August, and that was the first time that I purchased the stock. And of course, as with most of my positions, I didn't jump in with a full position. I kind of started with an entry-level position. And my intentions are that over the coming months, over the coming year, I will look to add and build up that position. So that's why New Flyer is on my list of stocks for 2020. It pays, like I said, a very attractive dividend up at 6.4%. And New Flyer Industries is the first stock that I will personally be buying in 2020. Joe, can you get me that second report, stock number 2, please? Wonderful. Thank you, Joe. Perfect. Moving on to the second stock that I will personally be buying in 2020. It's the company Cisco Systems. The ticker is CSCO. And this is a stock that I don't currently own. It's one that I've wanted to for a long time. And I'm thinking that 2020 will be the year that I finally pull the trigger. By taking a look at the share price, I do believe that we may have an opportunity coming our way. And it's one that is, like I said, high on my radar. I'm going to monitor it quite closely because we've seen a bit of a drop, and I've got my fingers crossed that this drop continues into the new year. But Cisco is a company that we all probably know quite well. They are a global tech company, been around for quite some time. They do have all sorts of products, but commonly we can think to things like switches and routers. You may have one in your house if you're watching this video. What I want to first address, what I love about the company is their dividend. And Cisco is a great option as a dividend growth stock play. Its current dividend yield is 3.16%. It actually only started paying dividends back in 2011. They actually bumped the dividend up real quick the couple years following, kind of ramped it off. But all in all, over a 5-year period, we're looking at a growth rate of 20.21%. And they're doing this with a 43% payout ratio, which are just some stellar numbers regarding the dividend. To me, I always find it a bonus when you can get your hands on a tech stock that is giving you a 3+% yield. And Cisco really does fall into that category. And they are, this is a company that is going to be highly involved with the 5G rollout. As this rollout takes place, That's of course going to call for a lot of hardware upgrades. Think to things like your router basically needing to handle, or for it to operate on the new network, they will require some upgrades. And it's really not the biggest deal to me, the whole 5G rollout, but I know on YouTube, it's something that a lot of people, we get a lot of questions on. Yes, they will be involved in that. And what really appeals to me about the stock is that Cisco was down actually pretty heavy on their recent report. In the recent quarter, they did actually beat on revenues, top line and bottom line, but they did have some weak guidance going forward. And they're actually forecasting a 3 to 5% decline on a year-over-year basis. So understandable why investors weren't all too happy. You'll notice that revenues only up 2%, right? Not a whole lot of growth with this company whatsoever, but that's what I think to actually be pretty cool about the company Cisco. And it's something that actually draws me in, because Cisco is a company in a very interesting period, in a very interesting transition, as they're going from a high growth tech stock over the past number of years, and they're really on the forefront of transitioning into this mature and stable dividend growth play. And we look to a metric like what I believe to be important, $3.2 billion in services revenue. And when we say services revenue, a lot of this is recurring revenue for the company. This is actually a tweet from Cisco. It goes back to Q2 of last year, but 33% of revenue the company generated was recurring. So subscriptions and ongoing fees that they collect. I believe now they're actually hoping to get that up to like 50%, which is absolutely crazy. But this is really key for helping the company weather some storms. So as we do know, talk of recession, and whenever a downturn does hit, having that recurring revenue, having a reliable stream of cash flow, not only helps you weather those storms and get through those periods, but it's also great for a company that is actively growing their dividends. And to look at it optimistically, at least a comparison that did come to mind as I was doing my research into the company Cisco, is I did draw the comparison to the company Microsoft. And I'm thinking to Microsoft a number of years back, before Satya Nadella came in and really shifted the business model to more of a service-based, rather than relying on hardware like how things used to be. It's pretty safe to say that that worked out quite well for Microsoft. Of course, we're also seeing Apple take this route. They're heavily investing in their services business. It is a super high margin, and like I said, just a super reliable source of income, reliable source of cash flow for the company. And I really do like the decision that management has made for Cisco to really take this approach and almost follow some of these big tech giants that have clearly been so successful. The stock currently trades for $43 USD. You'll notice here, it is down about 25%, kind of quietly off those highs. I've been waiting really patiently to add the company Cisco to my portfolio. It's one that I've been watching for, it feels like, a number of years, and I never thought the time was right. But as we're seeing this drop, like I said, it's one that I'm going to monitor quite closely in the case that we do see it decline a little bit further, because I'd love to add a tech stock with a 3.19% dividend. So all that being said, Cisco is the second stock that I personally plan to buy in 2020. And I got to thank the elves. They worked very hard on this one. They really put their mind to researching this stock, and I got to commend them for all the great work they did picking this one out. Moving on to our final stock for the video. Jesse, can you grab me that third report? Stock number 3, please. Thank you. Yes. Yes. Moving on to our third and final stock, the final stock that I will be buying in 2020, it's the company Tencent Holdings, ticker TCEHY, and it does trade over the counter. So that is something that if you are going to research this stock a little further, you may want to clarify with your broker. It does trade OTC. This is, of course, the Chinese tech giant, and they really are involved all over the place, as we'll look at in a second. This was, for a fun fact, this was actually the first Chinese company to ever hit a $500 billion market cap. So really, a giant of a company. Its main businesses, for anybody not familiar with Tencent, they do revolve around social networking platforms, along with a huge gaming business. But as you can see, peripherally, the reach is still very wide and very powerful. But they're also number one in terms of daily active users, monthly active users in video streaming, news outlets, music streaming. They have a massive payment system, which will actually take up a good portion of this segment. They're the second largest cloud provider in China, along with utilities and, like I said, online games. The company makes money, kind of their business model, in four primary ways. They got their fee-based revenues, so we can think of things like subscriptions to their streaming services. They have online purchases for apps or video games or games. Advertising is key, very much like we see on YouTube or Facebook, advertising their online platforms. And then, of course, they have their transaction-based fees on their payment system. And really, a lot of this business does stem from the very popular WeChat. And if you're not familiar with WeChat, think of WhatsApp here in North America, but on steroids. Because WeChat is a platform that recently passed over 1.15 billion monthly active users. And you can just see the strength of it compared up to our social platforms such as Facebook, YouTube, WhatsApp. Currently, as of October 2019, actually larger than Instagram in terms of monthly active users. So although it's not so popular here in North America, over in Asia, this platform really is everything. Within the app, you can book movie tickets, you can hail cabs, play games with friends, and of course, send messages and chat back and forth. But they also have a payment system. And as I was touching on, they have an e-wallet with vast capabilities. It's called WeChat Pay. Here you can send money back and forth. You can link up your credit card to facilitate payments, basically by scanning these QR codes, very similar to our modern day e-wallets. This is the largest mobile payment system in China, and it facilitates on average over 1 billion transactions per day, which is just insane to think about. Aside from that, they are also a major player in the video game space. They own companies like Riot Games, as well as a stake in Epic Games, just to name a couple, meaning that Tencent is really, they're the company behind League of Legends, Arena of Valor, even Call of Duty and PUBG Mobile, which are some of today's most popular video games. You can see really two things here. You can see the rapid growth that the company is seeing in terms of their revenue growing year over year, and you can see the different breakdowns between the different segments of their business. And to me, what is really telling from this graph is this pink area. The pink area of the chart showing very promising growth in monetizing their payment system. And I've mentioned already a number of times on this channel, but I really do believe in the whole e-wallet, the digital payment space going forward. I think that is going to be such a crucial part, such a crucial aspect of our lives over the next 5, 10, 15 years. Hence why we're seeing the big giants all taking their pick and at least trying to get their hands on some sort of payment system here in North America, as well as overseas. To me, we're clearly moving towards a cashless society. And it's not even out of the question for me to think a number of years down the road, we may not even have the need for a wallet. Like, why would you need to bring out your credit card, and why would you need to not bring out cash when you can just swipe your phone, or you can just scan your phone and have everything on there? You know, it's kind of goofy to think about, but really an average already of 1 billion transactions per day. To me, that just shows the potential of this market, and Tencent is just really primed to take advantage of that and just grow. Now, the stock has been underperforming over the past 2 years. I've actually owned the stock since 2017. And of course, being a Chinese company, it has been dragged down kind of with the overhanging trade war. Kind of sucks just in general, but that's just the way it is. Definitely playing a part here. It's currently trading at a market cap of $400 billion. And I'm not exaggerating when I say this. I do see the potential for this company to reach that $1 trillion market cap. I do think that a company like Tencent belongs up with the tech giants, the Amazons, the Googles, and the Apples. It's obviously a long-term outlook I have here, but I would not be surprised if the company did double in size from where it is today. You can see that the revenue growth has been declining, kind of corresponding actually with the drop in the share price. But if we do just take a second to look at the sizes of these numbers, like how large these year-over-year growth numbers are, even after a slump, the company is growing at 27% for a massive company like this. That is still very, very impressive. And dating back to 2017, these are some very strong numbers the company was pumping out. So to me, with the stock down still about 30% off of its highs, it is actually a very attractive buy. And believe it or not, as much as I love Tencent, and I feel like I'm always hyping it up here on the channel, it is one of my favorite companies, one of my top stocks over in China. I am currently down on my position from the shares that I bought when it was trading a bit higher. I'm taking this as an opportunity to really just average down on those shares, really try to get this position back up in the green. When I look at the scope of my portfolio, this is an area that I feel could use some improvement. And that's why, to me, again, with the stock down 30% off its highs, I will be adding to it over the coming year. The stock currently trades for $42 USD. It pays a very small dividend yielding 0.23%, but Tencent Holdings is the third and final stock that I will personally be buying in 2020. So guys, those are 3 stocks that I do personally plan to add over the coming year. Let me know what you think of my picks. Do you think those are good ideas? Do you think those are bad ideas? Like I said, this is by no means direction or advice for you guys. I'm simply sharing with you what I plan to do, just some of the stocks that I have high on my radar. As always, if you enjoyed the video, feel free to give this one a thumbs up and subscribe for more content. Like I said, if you are a beginner, there is a free case study on our Investing Academy. You can click that one down below, but I had a total blast putting this one together. Just really a lighthearted video for you guys to take with you into the holiday season. I guess I'll just call over the elves who played such a good role in putting this video together. Joe, Jess, get over here to say goodbye to the guys. Say goodbye to the people. Joe, Jess, guys. Thank you guys for watching today's video. I really hope you enjoyed. If you did, again, feel free to drop a quick thumbs up. That is a great way of supporting the channel. Also, we do videos every week on all types of investment topics, so be sure to subscribe if it is your first time here. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.